everyone, and welcome to the Knowledge Shop Tax Monthly Roundup for October 2025. I'm Amy, and joining me today are Mike and Jason. It's been another full month of tax and super updates, and we've got plenty to cover. There's been a really interesting case dealing with the sale of pre-CGT shares and some pretty big announcements in the superannuation space that could have wide-reaching implications. Mike, let's start with you. There's been a case that's had a lot of practitioners talking recently. It looks like there's been an interesting case dealing with the sale of pre-CGT shares in a company. Can you walk us through what happened and what the tribunal decided?
Yeah, interesting case that we're looking at this month, where all the parties basically in the case, we have pseudonyms being used as their names. And so effectively what we had was a dispute over the tax treatment that related to the sale of some shares. And the taxpayer basically argued that basically there should be no tax implications because these shares had been acquired pre-CGT, while the Commissioner was arguing that some special integrity rules in Division 149 basically caused these shares to almost be reset as post-CGT assets. But let's have a bit of a look at how the kind of case played out, some of the key facts, and then we'll have a look at some of the technical analysis as well, because it's a little bit complex. So effectively what we had here was a discretionary trust that was settled back in the 1970s. So it was a pre-CGT trust. Now, at some point a little bit later on, now it was post-CGT when the trust acquired some shares in a company. Alpha Proprietary Limited is just the name that's been kind of given to this arrangement for the purpose of the tribunal decision. Now, the shares were acquired actually post-CGT, but they were deemed to have been acquired pre-CGT, presumably because a form of rollover relief had been used when kind of getting those shares into the trust. So it seemed to be accepted that these initially anyway were pre-CGT shares sitting inside this discretionary trust. Now, sometime later, around 2011, some amendments were made to that trust and a new corporate beneficiary was appointed or added as a new potential beneficiary of that discretionary trust. We went further down the track and it was in the 2020 income year, the trust eventually sold the shares in Alpha Proprietary Limited, the first company. And the sale proceeds for those shares were pretty significant. We're talking around $100 million, sale to an unrelated party. At some point shortly thereafter, a portion of those sale proceeds, around $64 million worth, were distributed to the applicant from that trust, and it was accepted that this distribution basically could be traced back to the sale proceeds from those shares. Now, many of you would be aware that when we acquire or hold a pre-CGT asset, so an asset that was acquired before 20th of September 1985, or where it's deemed to have been acquired before that date, normally any capital gain or loss we make on sale of that asset will be disregarded. These shares were deemed to have been acquired pre-CGT, so the taxpayer assumed that capital gain would be disregarded, and therefore there would basically be no tax implications when that gain was kind of passed out to a beneficiary. The Commissioner, however, took a different view of this. Now, yes, there is a general exemption for pre-CGT assets, but it's not quite as simple as that because there are some provisions in the tax system which can kind of undo that tax treatment. And the particular provision that ATO was focusing on here was the rules in Division 149. Now, Division 149 basically says that where a pre-CGT asset is held in a company or a trust, and there are significant changes to the ownership, the underlying ownership of that asset. So, for example, changes to the shareholders of a company or the unit holders of a trust, for example, that can cause the pre-CGT asset to lose its pre-CGT status. It basically is now treated as a post-CGT asset and it's given a new market value cost base. Well, the ATO argued here that by adding this new corporate beneficiary to the trust back in 2011, that triggered the rules in Division 149. The ATO said that you could no longer show that there basically was a continuity of majority underlying interests in the shares in the first company, Alpha Proprietary Limited, as a result of the change to the potential beneficiaries of the trust. This effectively was the dispute that was heard by the the tribunal. Now, the tribunal found for the taxpayer in this case, so a pretty significant win for the taxpayer because there's a lot of tax at stake involved in this situation. The tribunal went through a fairly technical analysis. These are quite technical rules. And it was noted that applying these rules becomes more difficult when you're dealing with a discretionary trust. Now, if we're dealing with a more simple scenario, say a company, we have, say, shares held by some individuals. Normally working our way through these provisions is not so difficult. You figure out who held the shares pre-CGT, and you keep monitoring to see whether there's any changes in shareholding. And we're looking for a point in time where basically we no longer have majority shares, so more than 50% held by those original pre-CGT shareholders. That's a more simple analysis. This wasn't that. This is more complex because it's a discretionary trust. How do you trace through and figure out who holds those majority underlying interests? How do you figure out what percentage interests those relevant parties hold? So the tribunal went through a fairly technical analysis in doing so. Look, I'm not going to go through that technical analysis in detail, but kind of the big picture summary here is that the tribunal basically found that the beneficiaries of this trust ultimately continue to be the same people and their family members. Now, we actually have a pretty old ATO ruling in this area, which suggests that basically when you're applying the rules in Division 149 to a discretionary trust, you will typically be looking at whether the trust continues to be administered for the same, basically, family group that it was being administered for pre-CGT. And the tribunal basically picked up a similar approach here. Now, this was a bit more complex because the shares in that new corporate beneficiary happen to be held by a hybrid trust, which again adds a layer of complexity. But ultimately, the tribunal was satisfied that these shares ultimately were still held by the same parties who held an interest in the shares pre-CGT. So the taxpayer had a win. The ATO's had a loss on this one, but we'll wait and see whether the ATO appeals it. So really complex set of facts and very complex technical analysis, but it does demonstrate that when you have, say, a new beneficiary being added to a discretionary trust that holds pre-CGT assets, that does not in itself necessarily cause those assets to lose their pre-CGT status. So it's not going to be an easy analysis, but there is some hope there for clients who might find themselves in a similar situation.
Thanks, Mike. Are there any other key issues advisors should be mindful of when clients hold or sell assets they acquired pre-CGT?
As I mentioned earlier, when someone holds and disposes of some pre-CGT assets, we will normally expect capital gains and losses to be disregarded. But in addition to Division 149, which can potentially cause those assets to lose their pre-CGT status, there are some other areas of the tax system that we do need to be careful about. The danger here is that clients will, having known that they've acquired the relevant asset pre-CGT, will sometimes just assume that they can sell that asset without any tax implications. And it isn't quite as simple as that, unfortunately. But three things that come to mind in addition to the rules in Division 149 that we need to be careful about. The first one is don't necessarily assume that the asset will end up being taxed within the CGT system. We do need to consider the possibility that the asset might be taxed on revenue account. For example, have a think about a client who might hold a property that's been held for many, many years. It's a pre-CGT property. They might undertake some development activities with respect to that property before selling it. Now, if it turns out that they are merely realising that asset in the most advantageous way, well, yes, we might be able to argue that the sale is on capital account, and we might find that we can disregard any capital gain or loss where it was a pre-CGT property. However, we might find that the development activities push that property onto revenue account, either as trading stock or as part of an isolated profit-making undertaking. If so, the gain that arises and that ends up being included in assessable income on revenue account and doesn't fall within the scope of the CGT rules, it won't benefit from that pre-CGT exemption. So that's the first thing we need to be quite careful about. The second thing is, and particularly relevant again for property situations, is that there are some rules that can apply when someone has acquired pre-CGT land or pre-CGT property and some improvements are made to that property post-CGT. Now, the first provision that we need to look at basically says that if you hold some pre-CGT land and you construct a building on that land post-CGT, the building is treated as if it was a separate post-CGT asset. So you might be able to disregard any capital gain or loss relating to the sale of the underlying land, but you might have a taxable capital gain on sale of that post-CGT building. We also have some provisions that basically apply where significant post-CGT improvements are made to a pre-CGT property. That could be relevant, for example, if you have a client who holds some pre-CGT land, there is an existing pre-CGT building on that land, but they undertake some major improvements or renovations to that building post-CGT. In that case, we need to look at the ATO's improvement thresholds. Every year, the ATO releases an updated improvement threshold for the income year, which basically it gives us a marker in terms of if we've spent more than that amount, well, we are basically at risk of that improvement being treated as a post-CGT asset. Now, it's a little bit more complex than that because we also need to look at the cost of that improvement compared to the entire proceeds from the sale of the asset. So we won't always necessarily end up with an issue, but it is an issue that does need to be considered. So that's our second thing. We might, for example, with property, end up with a situation where a portion of the property ends up being deemed to be a post-CGT asset. The third thing that we need to be aware of is CGT event K6. And this event can arise basically when a client holds pre-CGT shares in a company or pre-CGT units in a trust. Now, while the capital gain or loss on sale of those shares or units would normally be disregarded in the ordinary course of events, we do need to be a little bit careful about that because K6 can apply if there are significant post-CGT assets within that company or trust. Now, applying these rules can be quite tricky. There are a number of steps we need to work through, and we're not going to do that as part of this analysis, but I do just want to make sure you're aware that when a client is selling pre-CGT shares or pre-CGT units, there is an extra thing that we need to consider, and that is, could we potentially have a taxable capital gain that arises under K6? K6, in a nutshell, basically requires us to undertake a look-through analysis. We're looking at the assets that are held by the relevant company or trust. So the shares might be pre-CGT assets. We're looking through at the assets held by the underlying company. Again, a little bit more complex than that, but that's roughly what we're going to be looking at in a case like that. So don't assume that just because your client has acquired an asset pre-CGT that they can sell it with no tax implications. We've seen already that there are 4 different areas of the tax system that we will probably need to be aware of and at least giving some thought to just to confirm whether our clients are exposed to tax or not.
Great. Thanks for that, Mike. Some really useful reminders there, especially around how easy it can be to overlook those older asset histories. Now, Jason, it's been a big month in the superannuation space with a few key changes and announcements making waves. Can you talk us through what's been happening in super this month?
Indeed, it was a busy month in October for superannuation developments. We saw the introduction of the Payday Super legislation, and we also saw the Treasurer make an announcement that there will be some changes to the way the proposed Division 296 tax will work. So starting with Payday Super, the bill introduced has a start date of 1 July 2026. So the government are committed to this start date. It will require employers to pay superannuation on qualifying earnings within 7 business days. So originally it was 7 days, so now 7 business days. So giving employers a little bit longer to have those payments processed and into the employee's accounts. So qualifying earnings will be similar to ordinary times earnings that most of you will be currently used to. Despite the adjustment for employers and the more regular payments, we think once that they get used to that, there are some good benefits for this system. So currently, late payments and superannuation guarantee charge is not deductible. So under the current system, if the employer makes a small mistake and perhaps they're 2 days late, they lose the deduction, plus they face some penalties. Under the Payday Super system, they will still retain the deduction on that late contribution and also on any SG charge. So some benefits there for people that generally do the right thing but perhaps make a small mistake or miss a payment. The actual administrative penalties, so the punishments, they can be substantially higher for people that consistently do the wrong thing. So they can be up to 60% of the SGC amount. For those who self-disclose, so those who make a a one-off error and self-disclose and have a good compliance history, that 60% can be reduced down to zero. But those that don't have a good compliance history and don't self-disclose will be generally paying more in penalties. There's also a PCG that's also in draft form that sits alongside the proposal. So what the ATO are looking at is what type of compliance resources they might apply in that first year. So appreciating the fact that it is a substantial change. So the PCG is in draft form, but it is indicating that perhaps if people are still broadly falling in line with the current deadlines, that the ATO won't devote compliance resources to looking too deeply into those. So, but we'd certainly suggest that employers, fall in line with the new rules as quickly as possible so that they don't face additional penalties. The updated Division 296 announcement saw the government change the definition of income that they're proposing to use. It also saw some new thresholds as well. So previously, that measure looked at taxing amounts or taxing earnings on balances above $3 million, so taxing those earnings at an extra 15%. That has now been tweaked. So earnings on amounts above $3 million will be taxed at that extra 15%, but there will be another layer. So earnings on amounts 10 million and over will be taxed at a further 10%. So basically 15% on earnings between 3 and 10 million, and then 25% in total on earnings above that. There's also indexation being looked at as well. So indexation of the 3 million threshold and also the 10 million threshold in amounts of 150,000 and 500,000 respectively. So indexation in the future when CPI brings us to those levels. The most welcome part of the news is that this tax is only proposed to apply to realised earnings going forward. So previously it was a total super balance measure and it could have captured unrealised earnings, but now looking to redesign this to only capture realised earnings. What that exactly looks like is still open to consultation. So the Treasurer indicated there'll be some consultation, most likely for the rest of this calendar year, with a view to release this legislation sometime early in 2026. So a start date, again, of 1 July 2026. So that has been pushed back 12 months. So starting from that date, we wouldn't expect to see any Division 296 liabilities until at least sometime after 1 July 2027. And also the paper also talks about the fact that super funds will be notified when a member may be in scope. So the ATO would have information on members' total super balances across all their funds. And once a super fund is notified that someone's in scope, they will need to calculate this realised earnings amount. And exactly what that looks like, we won't know until sometime next year, but there may be some extra work for super funds on members that have been identified as in scope. So certainly once the consultation is over, we'll bring you up to date with any developments as soon as new information becomes available, but we're not expecting to have that definition of realised earnings until sometime in 2026.
Thanks, Jason. And with those proposed changes in mind, what sort of conversations should advisors be having with their clients right now?
Thinking about next steps, so starting with Payday Super, this is one that we really need to be proactive and get on the front foot with our clients. So although this proposal has been around for a couple of years, I think the 1 July 2026 start date might catch a few employers by surprise, and that date is certainly going to be upon us before we know. So we only have around 8 months to prepare for that. So certainly talking to all your employer clients, but in particular, the employer clients who have perhaps struggled with the current quarterly regime. We need to get those guys certainly in line very quickly for Payday Super. Also preparing them for a little bit of a challenging July 2026. So we're going to have employers typically juggling their prior quarter SG requirements under the current rules, and then also adapting to the payday requirements. So there are some transitional rules proposed. So looking at the fact that any payments that are made in that first 28 days of July, they'll firstly be allocated to the prior quarter's SG, and then after that, they'll be allocated to the current payday amount. So we'll need to make sure we have either paid our SG before 30 June, or if we're dealing with that all in July, we need to employers to make payments to cover the total of those amounts. Moving on to Division 296. So you've probably had some conversations with your clients who are potentially impacted by this. The good news is that the start date has been pushed out till 1 July 2026. So under the prior proposal, we'd already actually be in Division 296 territory, so not starting until 1 July 2026. And there isn't necessarily a reason for people to panic or have to do anything before 1 July 2026. So the first time earnings will be measured will be at 30 June 2026, so the end of that financial year. So certainly any clients that perhaps want to opt out of that tax, they will have up until that time to make any commutations. Also, once we get that definition of earnings, we can look at how that might impact a particular client, and then they can make an informed decision around whether they leave their money in super or whether they take that out and do something else. And of course, there is the conversation. So the people that are taking money out of super, whether that be for Division 296 reasons or not, we certainly need to consider what else they might do with it and how that might be taxed as well, just to make a fair comparison so that then they can make that final informed decision. So no real hurry on the Division 296 at this point, and we think it's best to wait until we have that definition of earnings sometime, hopefully earlier in 2026, and then clients can understand the impact and make that informed decision.
Thanks, Jason, and thank you both for those great insights. Before we wrap up, just a quick reminder that Knowledge Shop members have access to a whole range of resources designed to make practice life easier. That includes our popular help desk servers, work papers and templates, client newsletters, technical updates, and of course, our accredited training and updates. We deliver the certainty you need when you need it. That's it for the October 2025 Tax Monthly Roundup. Thanks for joining us, and we'll see you next time.